Warren Buffett. For decades, right? His name has pretty much meant brilliant investing. But how? How does he actually do it? Is it some kind of gut instinct? A crystal ball? Well, today we're going to pull back the curtain on his method, and you're about to see it's not a crystal ball at all. It's something much simpler and way more powerful, a checklist.
I mean, it's the question everyone wants answered, right? How does he consistently find these incredible, world-beating companies and just know exactly when to invest? Well, the answer, it might actually surprise you with just how simple it is.
Yep, that's it. The core of Buffett's strategy, it's not magic. It's a disciplined, repeatable process. It's a checklist. A checklist that separates the truly great businesses from the merely good ones, and then tells them if the price is right. It's a whole framework, and it's built on 2 key tests.
Okay, so the first part of this whole thing, it has absolutely nothing to do with stock prices. Seriously, it's all about the business itself. So before he even glances at the numbers, Buffett asks one simple question. Is this a business I'd want to own? Like the whole thing?
And to answer that big question, he uses this 4-point quality checklist. First up, the monopoly test. Does it have a crazy powerful brand or a unique spot in the market that just walls off the competition? Second, the earnings trend. Are its profits not just strong, but consistently growing? Third, a high return on equity. Basically, is it super efficient at turning shareholder money into even more profit? And finally, does it require low capital spending? Can it grow without needing these massive expensive upgrades all the time?
All right, so to see how this works in the real world, we're going to look at 3 classic Buffett investments from back in the 90s. And we're going to focus specifically on how those first 2 items on the checklist, that monopoly test and the earnings trend, helped him spot these legendary winners in totally different industries.
Okay, first up, a newspaper company. Gannett. Buffett started buying this one up heavily in 1994. Now, I know what you're thinking. A newspaper. Sounds pretty old school. But let's run it through the test.
This quote really gets to the heart of that consumer monopoly test. See, back then, most of Gannett's, 190 newspapers, they were the only local paper in their city. Think about that. If you were a car dealer or a supermarket, you had no choice. You had to advertise with them. That gave them incredible pricing power. So the monopoly test? Oh yeah, passed with flying colors. So what about the earnings? Well, you can see the trend right here. I mean, look at that. Over the decade before he invested, earnings per share more than doubled. That's a steady 8.6% growth every single year. That is exactly the kind of strong upward trend he loves to see. So with those first 2 boxes checked, Gannett was definitely looking like a great business. All right, next up, we're jumping to a completely different industry. We're talking about Freddie Mac, the mortgage giant. Buffett put more money into this one back in 1992. So let's apply that same checklist.
So you might be wondering, how on earth did a mortgage company have a monopoly? Well, here's the thing. Freddie Mac and its cousin Fannie Mae were actually created by Congress. They basically had a government-sanctioned duopoly on a huge chunk of the American mortgage market. This quasi-monopoly, as it's called, meant they had these massive built-in advantages. For Buffett, that was a super clear pass on the first test.
And just look at the earnings growth here. I mean, it was explosive. We're talking an annual growth rate of over 17%. It just sailed right through that second test. So boom, another certified great business. Okay, for our last case file, let's look at a company every single one of us knows, McDonald's. Berkshire Hathaway bought into this one in 1996, the ultimate brand name. So, does McDonald's have a consumer monopoly? Come on. With over 20,000 restaurants all over the world by 1996, the answer was a resounding, absolute yes. Those golden arches were one of the most recognized symbols on the entire planet, a true global monopoly in fast food. That is an easy, easy pass on test number 1. And the earnings? Again, just look at that consistent upward march. A growth rate of 13.5% a year for 10 years straight. See, the crucial point here is that it doesn't matter if it's newspapers, mortgages, or hamburgers. The first step is always the same. Use the checklist to prove to yourself that you found a fantastic business, one with a protective moat and growing earnings. Okay, so finding a great business, that's only half the battle. Now comes the second part of the framework, and it's just as important, figuring out if the price is right. And for this, Buffett uses this beautifully simple mental model.
He doesn't think of a stock as just some flickering ticker symbol on a screen. He thinks of it as what he calls an equity bond. So think about it. A regular government bond pays you a fixed coupon, right? Let's say 7%. And that's it. It never changes. But a great business, its coupon, which is its earnings, that has the potential to grow year after year after year.
Let's circle back to Gannett in 1994 to really see how this works. Okay, so Buffett has a choice. He could buy a super safe government bond and get a 7% return, or he could buy Gannett stock. Now, at the price he paid, the initial earnings yield was a little lower at 6.5%. But, and this is the whole game right here, that 6.5% coupon was projected to grow by over 8% a year. So which one would you rather own? The static, never-changing return or the one that's growing? Yeah, for Buffett, the choice was pretty obvious.
So, what's the big takeaway from all this? How can we actually apply this kind of thinking? Well, it all boils down to this powerful two-part framework.
First, you gotta put on your detective hat. Your job is to find a truly great business using that quality checklist. You're hunting for that monopoly, for that strong upward earnings trend. Then, and only then, do you put on your financier hat. And that's when you compare the company's initial growing yield to the fixed yield of a boring old bond to decide if you're actually getting a good deal.
And really, this is the fundamental mindset shift. You're not just buying a stock, a ticker symbol that bounces around all day. You are becoming a part owner in a real, living, breathing business. And when you start thinking like an owner instead of a speculator, believe me, the entire game changes.
The thing is, this framework is absolutely timeless. So the real question for us today is this. If you look around at the world, at the brands you use every single day, the services you rely on, which of them would pass that great business test? And of those, which ones are being offered at a price that passes the stock versus bond test? Now that's the billion-dollar question, isn't it?